Mark Gibson Human Risk Channel. Accountant with designations CPA, MBA, CMA, ACPA, ASA, Australia. Enjoy learning!
So, again, good morning, class, and welcome to your financial management class. So, today we'll discuss cash flow estimation and risk analysis. No? So, last week I have provided you with the PowerPoint material. So, today what we're going to do is we'll do a full discussion on cash flow estimation and risk analysis along with the different discussion problems. No? So, let's do this. Okay, so cash flow estimation. Estimating cash flow is most critical and important and most difficult step in the capital budgeting. If not reasonably accurate, no matter how sophisticated the analytical technique is, it can lead to poor decisions. The key is to consider only incremental cash flows. So class, take note, incremental cash flows. So when we say incremental, we only look into the relevant. So we only look at the relevant factors no, impacting your cash flows. No? So later on, we'll discuss what are those items that are only relevant to the project. No? So we'll also introduce different, say, factors like sunk costs. No? So when we say sunk costs or also opportunity cost. No? So when we say sunk cost class, these are the costs that won't have any impact to your decision making. Why? Because sunk costs are costs that are uh, already incurred, no? Whether or not you undergo or proceed with implementing a particular project. No? So opportunity cost naman, sabi natin, di ba? We keep on talking about this even before. No? So sabi natin, pag opportunity costs, these are costs that we forego no? from choosing an alternative. So financial staff's role in the forecasting process. So number one, obtain information from various departments. So lagyan natin dyan engineering and marketing. And ensure the use of consistent set of economic assumptions. Make sure there are no biases inherent in the forecast. So basically, these are our roles no? In the forecasting process. So conceptual issues in cash flow estimation. No? So cash flow versus accounting income. The firm's value is based on cash flows because cash is what firms use to spend or reinvest, and it changes the working capital of the project directly affects cash flows but not the net income. How cash flows differ from accounting income is a cost or fixed assets, non-cash charges, changes in net operating working capital, and interest expenses are not included in project cash flows. So pag-usapan mo natin ito quickly. So, when we're talking of the accounting income, ito yung pinag-uusapan natin palagi. No? So, we look into the profit and loss. So, di ba meron ka dyan sales, less your cost of sales, equals your gross profit, less operating expenses. So, meron kang operating income, less taxes. So, makuha mo yung net income mo. And that's it. That's your accounting income. Now, of course, no, when we look into the cash flows naman of a particular project, syempre, dahil nga pinag-uusapan natin cash flow lang, so we look into cash flow items only. So definitely, one good example of non-cash item or non-cash charge would be your depreciation. No? So previously, we look into your statement of cash flows and you learn at that point that non-cash items should be added back, no? In order for you to get to should be added back to your operating income or net income, no? In this case, in order for you to get to compute for the net cash flows. So timing of cash flows deal with cash flows exactly when they occur. For simplicity purposes, we assume year-end cash flows. So later on, we'll demonstrate that. Incremental cash flow that will occur if and only if the firm takes on a project. They should be included in estimating cash flows. No? So ito class, this is important kasi nga, we should only look into, di ba kanina sabi natin, relevant cash flows or ito nga incremental cash flows. No? So if a particular cost item is not relevant, then we shouldn't be including that as part of the cash flow estimation. So replacement projects where the firm replaces existing assets. Number one, to reduce costs, and number two, increase operational efficiency. So anong good example na to? Ito yung, say for example, you have an old machine, and you want to replace it with a new machine that is that can increase operational efficiency. No? So for example, yung old machine mo, dahil nga siguro sa kalumaan, can no longer perform 8 hours in a day. No? So sabihin na natin gano'n. So dahil nga luma, so you can only use it for 4 hours, and then basically the manufacturing process has to be stopped. No? And with the introduction of the new machinery, and of course, dahil nga state-of-the-art, it has a state-of-the-art technology, you know, so it can now perform 8 hours and at the same time reducing your costs. No? So these are just good example of when to replace a machine or replacement project. So ito nga, isang cost. No? So sabi natin, cash outlay that has already been incurred and that can't be recovered regardless of whether the project is accepted or rejected. And therefore, they should not be included in estimating cash flows. Kasi nga, sabi natin, di ba, whether you accept or reject the project, itong mga sunk costs, you have already incurred this. So, I'll give you an example. For example na lang, meron kang rental space. No? So, meron kang warehouse which houses all your inventories and all your machines. No? You are renting that out for, sabihin natin, 20,000 pesos. Here comes a project, no? Project replacing a machinery. So, kung gano'n lang yung example natin kanina, kung natin. So, whether or not you proceed with replacing an old machine, that rental cost for the warehouse has already been paid for. So therefore, yung rent natin won't impact your cash flows for the replacement of the machine. So, pansinin yung class, that's important kasi nga naman, whether or not you replace the machine, yung rent for the warehouse has already been incurred. So, hindi mo naman na ma-recover yun regardless of whether you proceed or not with the replacing of the old machine. So, yun yung sunk cost class. Opportunity cost. So, the best returns can be earned on assets that firm already own if those assets are not used for the project. They should be included in estimating cash flows. Okay, so opportunity cost naman, sabi natin, these are the benefits that you forgo for um, choosing an alternative. No? So in this case, you should be including this as part of uh, the cash flows estimation. Externalities. So they should be included in estimating cash flows. No? So negative within firm externalities or cannibalization for substitutable products. No? So ito, ano bang good example ng uh, cannibalization? So when we say cannibalization, with the introduction of this product, it will eat up portion of your existing sales. No? So uh, meron akong naalala na good example from uh, back from my uh, MBA days. No? So that they in marketing they call it flanker brand. No? So basically ang purpose ng flanker brand is to introduce a product that is uh, that they can sell at a much lower price compared to the main product. No? So ito yung San Miguel beer and at the same time Gold Eagle beer. Yung Gold Eagle beer, ito very popular in the province. I'm not sure if you heard about this or if you know or if this is still existing. So Gold Eagle beer is said to be a flanker brand of the yung main product ng San Miguel beer. So in the process, of course, since Gold Eagle beer is introduced somewhat of the same quality of San Miguel beer pero nga mas mababa ang presyo. So in the process, it cannibalized the portion of the sales of the San Miguel beer. So positive within firm externalities naman, ito naman yung complementary products. No? So ano ba yung mga good example of this? No? So condensed milk. No? So condensed milk, ano ba yung with the introduction of all-purpose cream, ayun. No? So these products complement each other. No? In fact, you cannot do fruit salad right now without the condensed milk and the all-purpose cream. So just a classic example of complementary products. Environment externalities. When a firm's project can harm the environment, firm can boost up goodwill when spending for the environment. So it has something to do with being environmental friendly naman. So environmental externalities. Ito, ang palagi kong example dito is the introduction of a much safer ingredient daw for breeze. So ito yung sabon na may comparable to 10 kamay daw. So, I don't know, but they're telling that this product, that they're introducing a product that is a is environment friendly. And of course, no, sabi natin, there are individuals who opt to support these kinds of products over the others. No? So ito yung mga environment advocate. Okay, so with that, let's go to discussion problem number 1. So let me read the problem. As assistant to the CFO of Boulder Incorporated, you must estimate the year 1 cash flow for a project with the following data. So the requirement is, what is the year 1 cash flow? So given are your sales revenue, 13,000, depreciation, 4,000, other operating costs, 6,000, and tax rate of 35%. So let's do discussion problem 1. Plus, siguro one more thing, no? Anyway, makikita naman natin dito sa discussion problem 1. You have to make sure that the baseline would be your net income. No? So when we say net income, tax rate is already, the tax expense has already been deducted. No? So let's do this. No? So problem number one, tinatong sa atin, how much would be your cash flow for year one? So you have your sales revenue. Ito naman class, di ba sabi natin kanina, your baseline would be your accounting net income. So let's compute for your net income. So sales revenue, we have 13,000. That's given. Operating costs, 6,000. That's also given. Less the depreciation of 4,000 also. Tandaan class initially we're just computing for your accounting net income first. No? So that's why depreciation has also need to be deducted. Kasi otherwise, kung hindi mo na isasama yan, thinking na, not cash expense yan. So we should exclude that. No? Magkakaroon ka ng error in terms of the calculation of your operating income. No? So it won't give you the correct operating income. Kung mali ang operating income mo, edi mali rin yung tax expense na mako-compute mo, or mali rin yung accounting net income. So be careful that your baseline should be your accounting net income. So of course, get the sum, or difference yan, you get 3,000. So 3,000, kunin mo na ngayon yung tax expense. Tax expense is 35%. Ito, be careful with this class. In financial management courses, as well as in your management accounting services, tax rates will be provided as part of the problem. So in this case, 35%. So 35% of 3,000, that's 1,050. So from here, pwede natin makompute yung net income natin. So that's 3,000 less 1,050, that's 1,950. Now, we add back all the non-cash expense. No? So in this case, we only have one. No? So depreciation. So 1,950 plus 4,000. So that's 5,950. Ito ngayon yung cash flow natin for year one. No? So it's actually your net cash flow for year one. So simple lang class, no? So all you have to do is, number one, compute for your accounting net income. So meaning compute for your usual, prepare your usual profit and loss statement, and then add all your non-cash expense to get to your net cash flow. So that's problem number one. Okay, let's do another problem. Your company, RMU Incorporated, is considering a new project whose data are shown below. What is the project's year one cash flow? Okay, so let's have problem number two. So given our sales revenues, 22,250, depreciation of 8,000, other operating costs of 12,000, and tax rate of 35%. So let's have problem number two. So problem number two class, just the same. We just need to compute for our accounting net income first, and then add back all non-cash expenses. So we have 22,250 our sales revenue. So pansinan class na. So this is just for you to be comfortable with this type of problem, kasi problems 1 and 2 are of the same format. So later on, we'll do another format of problem. So less operating expenses of 12,000, depreciation of 8,000. So to get your operating income of 2,250, basically that's 22,250 less 12,000 operating costs less 8,000 depreciation. So that's 2,250. So 35% down tax rate, 2,250 multiplied by 35%. So that's 787.5. So 2,250 less 787.5. So this will be your net income, no? Amounting to 1,462.5. So again, add back all the non-cash expenses. So in this case, we only have one. That's your depreciation of 8,000. So 1,462.5 plus 8,000. So that will be 9,462.5. This is your cash flow for year. That's problem number 2. Okay, so let's do another format, another problem. Clemson Software is considering a new project whose data are shown below. The required equipment has a 3-year tax life, after which it will be worthless and it will be depreciated by the straight line method over the years. The revenues and other operating costs are expected to be constant over the project's 3-year life. What is the project's year 1 cash flow? So given our equipment costs, depreciable basis 65,000, straight line depreciation rate 33.333%, sales revenues each year 60,000, operating costs excluding depreciation 25,000, and you have your tax rate of 35%. So let's have discussion problem number 3. To class, pansinin, compute muna natin yung depreciation. So we have the equipment life of 3 years that's given. That's 3 years. No? So equipment cost of 65,000, ay sabi di ba, straight line depreciation for 3 years. So therefore, 21,667 per year. Okay. So sales revenue natin, again, no? So we proceed with the procedure, no, to compute for your cash flow. Number 1, of course, is to compute for your accounting net income. So sales revenue, we have 60,000 that's given, less depreciation of 21,667. Less, of course, your operating cost, sabi dyan, excluding depreciation. So be careful with this kasi there will be times that the operating cost, definitely depreciation is part of your operating cost. No? So there might be problems where operating cost includes depreciation. So just read carefully. No? So depreciation, operating cost is 25,000. So therefore, your operating income would be 13,333. Multiplied by 35%, tax expense would be 4,667. 13,333, your operating income less tax of 4,667. So your net income would be 8,667. Add now the operating non-operating expenses. So in this case, we only have one, amounting to 21,667. So 8,667 net income plus depreciation of 21,667. So that's 30,333. So that's letter A. That's problem number. Okay, determining project value. So terminal cash flows, we have the recovery of net operating working capital plus the salvage value less the tax on salvage value to get your terminal net cash flow. In fact, class, actually, that's the same, no, of what we have discussed in problems 1 to 3 earlier. So identifying relevant cash flows. So based on cash flows, not accounting income, only includes incremental cash flows, includes cost of fixed assets and change in the net operating working capital, add back non-cash expenses. Financing effects are not included, thus do not include interest expenses. Also do not include dividends. So yan naman na yung pinag-usapan. Interest expenses is not subtracted because you'll have to discount the cash flow at the weighted average cost of capital. If you subtract the interest, you're double counting the cost of debt. So apologies for the error no, in typing. Depreciation shields net income from tax, but is actually not a cash expense. No? So you must add back to get the free cash flow. Ito naman na yung mga discuss natin kanina. So incremental cash flows, changes in cash flows as a direct result of accepting the project. Net cash flows attributable to an investment project. Okay, so we've discussed sunk costs, opportunity costs, and externalities earlier. Okay, ito, I've also provided you an example of how inflation impacts your cash flows. Of course, there will be impact of the inflation. So sabi natin, inflation is the rising in prices, and of course, if there are increase in prices, no, ergo the purchasing power of the people will decline. So this is very prevalent these days. No? So with the prices of gasoline increasing. So recently nga, parang 2 weeks ago, I cast out nasa 78, no? But a few days ago, it was at 82 pesos. No? So, kailangan malakas ang loob mo pag magpapa-full tank distance no? Sa inyo. Okay, so let's have discussion problem number 4 to illustrate that. So Liberty Services is now at the end of the final year of a project. The equipment originally cost 22,500, of which 75% has been depreciated. The firm can sell the used equipment today for 6,000 pesos and its tax rate is 40%. What is the equipment's after-tax salvage value for use in a capital budgeting analysis? Note that if the equipment's final market value is less than its book value, the firm will receive a tax credit as a result of the sale. So ito naman class ha, basically this problem number 4, something to do with accounting for your salvage value. No? So how are we going to treat that? So let's have problem number 4. So percentage depreciated on equipment, ayan, given naman 75% depreciated na daw. So therefore, and the tax rate is 40%. So kung 75% depreciated na yung machine, so 25% is left for the machine. So equipment costs, we have 22,500 pesos. Accumulated depreciation, So accumulated depreciation natin is equivalent to 75%. So that's 22,500 multiplied by 75%. That's 16,875. Ito naman yung usual, no? Just to get to your book value. So current book value of equipment is 5,625. So how much is the market value? So also given, it's 6,000. So basically, ganito yung class. For that particular equipment, all the equipment, so your current book value is only 5,625. And yet, you can sell it. No? You can sell that particular machine. You look into the market, it will, you found out that the market value is 6,000. So kung binenta mo siya, technically you will have gain or loss. So you will have gain amounting to 375 pesos. Kasi nga naman, ang book value na lang is 5,625, and yet you can still sell it, no? For how much? For 6,000. So technically, you would have a gain of 375. So, but take note, no? It has to be tax, no? So 375 multiplied by 40%, so that's 150. Now to get to your the market value, so basically that's 6,000 less 150, so that's 5,850. Ang tinatanong kasi sa atin is, what is the equipment's after tax salvage value for use in capital budgeting analysis? So the answer is 5,850. So that's 6,000 less the tax of 100. So pansinin class, every time that we compute for cash flows, no, for your capital budgeting, it has to be expressed after tax. Kasi nga naman, there's cash flow involved in paying your taxes. So in this case, the salvage value should be after tax of the gain, no? So take note of that class, it has to be the taxes paid on the gain if we're going to sell it. Okay, so that's problem number 4. So, problem number 5, Tex-Mex Food Company is considering a new salsa whose data are shown below. The equipment to be used would be depreciated by the straight line method over 3 years and would have a zero salvage value, and no change in net operating working capital would be required. Revenues and other operating costs are expected to be constant over the project's 3-year life. However, this project would compete with other Tex-Mex products and would reduce their pre-tax annual cash flows. What is the project's net present value? So ito class, no? In this case, we're just being required to compute for our net present value. So, but there's an impact of externalities. No? So sabi natin, with the introduction of new salsa, and meron daw palang impacto dun sa existing product ng Tex-Mex. So we call it cannibalization. So ito yung naging example natin kanina with San Miguel beer and its flanker brand called Gold Eagle beer. So let's continue reading the problem. We have the weighted average cost of capital of 10%, pre-tax cash flow reduction for other products of 5,000, investment cost of 18,000, straight line depreciation of 33.33%, annual sales revenue of 67,500, annual operating costs excluding depreciation of 35,000, and tax rate of 35%. So, considering the class, the tax rate, I'd like to point this out again and again. We should use the tax rate given in the problem. In this case, 35%. Pero kung napansin nyo, in problem number 4, it was at 40%. So do not argue with the tax rate. There's a separate subject of taxation. So in there, the tax law will apply. Okay, so let's have problem number 5. So of course, in computing for your net present value, so we have discussed this a number of times. So it has to be the present value of your cash inflows less cost of investment. Sabi nga natin, so long as your net present value is positive, then we can accept the project. So isa-isay natin ito, class. Ha? Of course, no? In this case, we have to compute first our cash inflows. Kasi nga naman, we cannot compute for our net present value without getting all the, without forecasting all the cash flows involved. So, tandaan, this is just a forecast. So sales revenue, so sabi dito, no, cash flow are constant. So sales revenue will be constant. So year 1, year 2, and year 3, that's 67,500. That's given. Cannibalization costs, no, 5,000. So of course, no, we have to include that in our calculation. So ito kasi yung this is not sunk cost, this is sabihin natin opportunity loss in this case. Kasi nga naman, with the introduction or with the purchase of new machine and introduction of new product, ano yung naging downside mo? Of course, cannibalization. So you have to take into account the impact to your existing products. In this case, cannibalization of the existing product amounted to 5,000. Operating costs excluding depreciation, that's 25,000, also given. Depreciation, no? Depreciation, that's 80,000 multiplied by 33.33, or simply 80,000 divided by 3. So that's 26,667. So it's also gross. Operating income, we have 10,833, also give. We can compute. No? So that's 10,833 multiplied by 35% to get your tax expense. So that's 3,792. 10,833 less 3,792, we get 7,042. Again, add your depreciation or other non-cash expense. So that's 7,042 plus 26,667. That's 33,708. So at least, no, we have completed the calculation of our project's cash flow. So that's 33,708. Again, in this case, we use the present value of 1. No? Kasi nga naman, cash flows are constant. No? So we use the weighted average cost of capital at 10%. So at year 1, we have 0.909. So 33,708 multiplied by 0.909, that's 30,641. Next, year 2, that's 82, that's 0.8260. So 33,708 multiplied by 8260, that's 27,843. And finally, year 3, 0.751 multiplied by 33,708, that's 25,315. So get the sum to get your present value of all cash inflows. That's 83,799 less your cost of investment amounting to 80,000. Ito yung investment cost natin of the machine. So the net present value is 3,790. Yan, no? So medyo naging mahaba yung process. Pero kung napansin nyo, it's procedural. So all you have to do first is compute for your accounting net income, add back your non-operating expenses, non-cash expenses to compute for your cash flows. And then from there, we compute for the present value of our cash inflow and then less your cost of investment to get your net present value. So that's problem number 5. Well, the answer is 3,799. That's problem number 5. Okay, so let's do another problem. The SI in industries is analyzing an average risk project. The following data have been developed. Unit sales will be constant, but the sales price should increase with inflation. So naman, yung impact naman ng inflation in our cash flows. So fixed costs will also be constant, but variable costs should rise with inflation. The project should last for 3 years. It will be depreciated on straight line basis, and there will be no salvage value. No change in the net operating working capital would be required. This is just one of the many projects for the firm, so any losses on this project can be used to offset gains on other firms' projects. So what is the project's expected net present value? So given your weighted average cost of capital of 10%, net investment cost of 200,000, units sold 50,000, average price per unit year 1, 25 pesos. Fixed operating cost, excluding depreciation, again constant for 150,000. Variable operating costs per unit for year 1 of 20.20, annual depreciation of 33.33%, expected inflation rate per year of 5%, so tax rate of 40%. So it's our problem number 6. Excuse me. Okay. So in this case class, we'll analyze the impact of inflation in our cash flow. So how much ba is our price? Price daw natin or selling price ng year 1 is 25 pesos. Diyan mo na focus on this one. So kung year 1 is 25 pesos, sabi natin inflation rate daw is 5% year on year. So we just have to increase our price. So that's 25 multiplied by 105% or simply 1.05. So that's 26.25. And then year 3, 26.25 multiplied by 1.05, that's 27.56. So ano yung nag-i-impact? So with the inflation, of course, the selling price also increases. Pansinin nyo, yan naman talaga nangyayari in real life scenario. So with inflation rising, prices of the products also increase. Ano pa ba yung other factors that will also increase? Of course, variable cost. So sabi dyan, variable cost will also increase in relation to inflation. So year 1, we have 20.2, also given 20.2. And mag-i-increase din daw 5%. So 20.2 multiplied by 1.05, that's 21.21. For year 3 naman, 21.21 multiplied by 20, multiplied by 1.05. So that's 22.27. So at least na-establish natin yung mga increases. Unit sold stays the same at 50,000. Okay, sales revenue, year 1. 50,000 multiplied by 25, that's 1,250,000. Sa year 2, 50,000 multiplied by 26.25, that's 1,312,500. Year 3, that's 50,000 multiplied by 27.56, or 1,378,105. Fixed operating costs, o yan, dahil nga fixed. So it will remain the same. So 150,000 across. Variable operating costs. So that's 50,000 multiplied by 20.2 for year 1, or 1,010,000. For year 2, that's 50,000 multiplied by 21.21, or 1,060,500. And then finally, for year 3, that's 50,000 multiplied by 22.27. That's 1,013,525. Depreciation expense, that's 200,000 divided by 3, 66,667 gross. So, kung kita natin yung mga expenses natin, we can now calculate for our operating income. So that's 23,333 for year 1, 35,333 for year 2, and then 47,933 for year 3. We calculate the tax expense. No? So 23,333 multiplied by 40%. So that's 9,333. 14,133 and 19,173 for years 1, 2, and 3 respectively. So makumpita natin ngayon yung net income natin. So 14,000 for year 1, 21,200 for year 2, and 28,760 for year 3. The next step, of course, is to add back your non-cash expenses. So in this case, we have our depreciation. So 80,667 for year 1, 87,867 for year 2, and 95,427 for year 3. So again, class, no? So weighted average cost of capital is 10%. Ay kunin ko lang itong present value table. Okay. So year 1, 80,667 multiplied by 0.9090, that's 73,336. For year 2, 87,867 multiplied by 0.8260, that's 72,578. And then for year 3, that's 95,427 multiplied by 0.7510. That's 71,666. So add these three to get your present value of cash inflows of 217,570. Yes, of course, your cost of investment amounting to 200,000. We have the net present value of 17,507. Okay, so that's problem number 6. Okay, so we go now to the second part of our lecture for the day on risk analysis. So in capital risk in capital budgeting, so as uncertainty about project's future probability. So it must address the question, will taking on the project increase the firm's or in stockholders' risk? Risk analysis is usually based on subjective judgment rather than historical data. So issues surrounding the analysis of uh, project risk. So we have the standalone risks, we have the corporate risk, and the market risk. So market risk class has something to do with beta. So again, beta is calculated by another profession. So we just need to make sure how to interpret. So standalone risk, the project's risk if it were the firm's only asset. So it ignores both firm and shareholder diversification. It is measured by the variability of the asset's expected return, so measured by the standard deviation or carrying value of net present value, IRR, or modified IRR. It is easier to estimate than corporate risk and far easier to measure than market risk. In general, all three types of risk are highly correlated. So if the general economy does well, so will the firm. And if the firm does well, so will most of its project. It is a good proxy for hard to measure corporate and market risk. Kasi nga class, on, in a standalone risk, no? So basically, we look into the project alone. No? So it is as if kaya nga standalone. No? So it will disregard all other projects and we look at this particular project as one standalone projects, no? At least in terms of risk assessment. Corporate risk reflects the project's effect on corporate earning. So it considers firms' others' asset. In other words, it is the project's risk to the company, considering the fact that the project represents only one of the firm's portfolio of assets. Usually, it is of concern to small business and undiversified shareholders. Pag sinabi natin ay undiversified shareholders, these are shareholders who put all their investment in one bucket only. So, put their investment in one industry only. It depends on project standard deviation and its correlation with returns on firms' other assets. It's measured by the project's corporate beta. Corporate beta is a quantitative measure of corporate risk. It measures the volatility of returns of the projects. It's relative to the firm as a whole. So undiversified stockholders are more concerned about corporate risk than about market risk. Empirical studies generally find that both market and corporate risk affect stock prices. Firm stability is important to its managers, workers, customers, suppliers, and creditors, as well as to the community in which it operates. No? So basically, class, corporate risk, ito, yeah, we look into this as a whole, in general. So basically, we have to look into externalities. No? So kanina pag-usapan natin that one project may impact the sales of an existing product, no? Within one entity. Excuse me. And also, introducing a product may complement naman another product within the same entity. So basically, as an accountant, our role is simply to provide report that will include those externalities in the analysis. Market risk. So it reflects the project's effect on a well-diversified stock portfolio. Market risk is the riskiness of the project as seen by a well-diversified stockholder who recognizes that project is only one of the firm's asset and the firm stands but one small part of the investor's total portfolio. It takes account of stockholders' other assets. So it depends on the standard deviation and correlation with the market, with the stock market. So basically, class, when we look at the market, ito naman yung we are looking into the market as a whole where the company is part of. No? So it's look, basically looking into the industry as a whole. So market risk is theoretically the best in most situations. It also the most relevant risk for capital project. For creditor, customers, suppliers, and employees are more affected by corporate risk. Standalone risk is easiest to measure, more intuitive, but we shouldn't always just focus on standalone risk. For projects are highly correlated with other assets, so standalone risk generally reflects corporate risk. In addition, corporate risk is likely to be highly correlated with its market risk. If the project is highly correlated with the economy, standalone risk also reflects market risk. So basically, class, those three risks are highly correlated. So meaning we have to look into all of those three and we shouldn't be disregarding one. So they are of equal importance. Oops. So there are different techniques in measuring standalone risk. No? So we have sensitivity analysis, scenario analysis, and Monte Carlo simulation. So basically, sensitivity analysis and scenario analysis, ito yung mga what if. No? So what if the net present, what if the inflation increases by this much in year 5? So what if the economic condition falls down in year 3? So what would be the impact to our project? Monte Carlo simulation naman, this is again another technique in measuring standalone risk, but is being prepared by another professional. So sensitivity analysis, percentage change in net present value resulting from a given percentage change in an input variable, other things held constant. It shows how changes in a variable such as unit sales affect the net present value or your internal rate of return. Each variable is fixed except one. Change this one variable to see the effect on the net present value or answers what if questions. So what if sales declined by 30%? What if inflation increases by 5%? So sensitivity analysis can provide useful insight into riskiness of a project. Kasi nga class, di ba? This is just forecast. Forecast is subject to change. No? So changes in terms of yung mga na-discuss natin risk factors like standalone risk, market risk, so corporate risk. And yes, I'll show it to you later that Excel is very helpful in terms of calculating your sensitivity analysis. The base case net present value less than net present value when sales and other input variables are set equal to the most likely or base case values. So to illustrate sensitivity analysis, let's have discussion problem number 7. Florida Car Wash is considering a new project whose data are shown below. The equipment to be used has 3-year tax life, would be depreciated on a straight line basis over the project's 3-year useful life, and would have a 0 salvage value after year 3. No change in net working capital would be required. Revenues and other operating costs will be constant over the project's life. And this is just one of the firm's many projects, so any losses on it can be used to offset profits in other units. If the number of cars washed declined by 40% from the expected level, by how much would the project's net present value change? Note that the cash flows are constant at the year 1 level, whatever the level is. So we have weighted average cost of capital of 10%, net investment cost of 60,000, number of cars washed 2,800, average price per car of 25 pesos, fixed operating cost of 10,000 excluding depreciation, variable operating cost per unit 5.375, annual depreciation of 20,000, and tax rate of 35%. So that's a problem number 7. Tsagain natin to class ha. Problem number 7. Of course, the first step is to compute for your accounting net income. And then add your non-cash expenses. So, okay, so cars wash, and given yun at 2,800. Magkano yung price? 25 pesos. Magkano yung variable cost per unit? 5.375. So, 70,000 in sales revenue. That's 2,800 multiplied by 25. Fixed operating costs given, 10,000. Variable operating costs, that's 2,800 multiplied by 5.375 or 15,050. Depreciation expense of 20,000 given. So we now have our operating income, 24,950. Tax expense, so that's 24,950 multiplied by 35%, that's 8,733. 24,950 less 8,733, we have our net income of 16,218. Add the non-cash expense. So in this case, we have depreciation, 20,000. So 16,218 plus 20,000, that's 36,218. So we now have our cash flow. So in this case, we compute our net present value. That's the next step. So this is at 10% weighted average cost of capital. So that's 0.1990. So ito pa rin, same table na gamitin ko because cash flow is constant. Okay. So that's 32,922 for year 1, 29,916 for year 2, 27,199 for year 3. Get the total, that's 90,037. Less cost of investment of 60,000 on the machine. So net present value is 30,037. Na. Sabi dyan, if the number of cars washed declined by 40%, how much would be the project's net present value? So, ginawa lang natin dito is we have to reduce the number of cars washed. So, from 2,800, we have to reduce it by 40%. No? So, that's 40% reduction. So, that's 2,800 multiplied by 60%. So, that's 1,680. Actually, yun lang naman yung nabago. No? And of course, kung nabago yung number of cars washed, there will be impact also to your total sales revenue. Kasi from 70,000 naging 42,000 na lang. Saan tayo may change? Sa variable operating cost. No? So variable operating cost from 15,050 naging 9,050 na lang. Fixed cost, of course, it's fixed. No? The of your fixed cost, it will remain fixed. As well as your depreciation. So your net operating income, your operating income is 2,870. Taxes, no? 2,970 multiplied by 35%, that's 1,040. Net income is 1,931. Plus operating your non-cash expense of 20,000, representing your depreciation. That's 21,830. Okay, so now we're ready to compute for our net present value. So year 1, that's 19,835. Year 2, 18,150. Year 3 is 16,470. Get the sum, that's 54,519. Less the cost of investment of 60,000, we have net present value of minus 5,481. Pansinin class, that the requirement is by how much would the project's net present value change? No? Of course, we have the base case and we have the bad case. That's this bad case net present value. So the change in the net present value would be 35,517.48 minus. So that's 5,480 less 30,036.71. So this is napansin nyo, of course, no, when you're taking up your quiz or your CPA board, this will be a lengthy process kasi you have to write it down, you have to calculate it one by one. But with the use of Excel, pansinin, pinalitan lang natin ito. No? So instead of 2,800, I reduced it to 60%. So representing the decline of 40%. So the Excel will then just calculate it for me. So in order for you to be familiar with this type of problem, so I suggest you to solve problems, no? As many as you can on sensitivity analysis. Actually, that's problem number 7. And that ends our discussion on cash flow estimation and risk assessment. So thank you for attending this session. If you have any questions, you can send me a note by my email address flash on your screen, or you can course it through your classmate. So, but before we end our session,
this has been your instructor, Mark Gibson. Thank you for learning with us. See you in our next discussion. Don't forget to like and subscribe. See ya!